Infinite banking is not complicated, but for whatever reason, we continue to complicate it time and time again. So in this video, we want to break down the concept again, and hopefully you all can understand some of the digestible pieces that we'll be going through.
Yeah.
My name is Carmen.
And I'm Darius. And what we're going to do is just break down the basics of infinite banking step by step.
Yeah.
And the very first thing that you have to understand when it comes to this banking is think about the current banks that you work with.
Yes.
What was their origin, or where did it start? Originally, banks were storage facilities for our money.
For income.
For our income.
Absolutely.
And then it wasn't until over time that things got more complicated, where they started lending money for expenses and charging people to have access to the money that they have stored at their facilities.
Yes. Yeah. And think about it. It's Monday. So on Friday, some of y'all got paid.
Right.
Where did that money go?
To the storage facility.
Yeah. Don't even think about names or companies or whatever it is. Your money had to go somewhere.
Right.
And it went to a bank account where your money is going to sit there. And you can stock it as often as you'd like and see how much money is in your account.
Right.
So that's all we're talking about, is changing the storage facility in which you put your money.
Yeah, because when it comes to infinite banking and using whole life insurance, it is just a storage facility. Just imagine it as being a savings account on steroids.
Yes, absolutely. So the savings account on steroids, you want it to work in your benefit, because right now there are two places you can put your money when you just think about banking. We're only talking about banking. You can put your money in a checkings account, or you can put your money in a savings account. And let's call it a money market as well. So when you put your money in any of these places, is your money doing anything for you? No, it's just sitting there.
But it is doing something. To us, is sitting there. But to the banks, what they've done is they've charged other people to have access to your money.
What do you mean by that?
So basically, banks are gatekeepers, and they have large storage facilities full of money. And when someone needs a loan or need to finance something, they charge people interest, or they charge people to have access to money that they didn't necessarily put there.
Yeah. Well, I'm glad that you said that, because when we first started this whole process, I'm going to speak for myself. I didn't understand that my money in the bank was being moved.
Yeah.
Does that make sense? Like if we're just bringing it down to its simplicity, I didn't realize that my money was not there. I just thought I paid my paycheck came in every Friday, or twice a month. My money was there when I needed it. When in reality, our money is actually not there, because the banks are taking our money and moving it around. Because how do you think the banks can lend money? They don't have like their own money that they're lending. And in some instances, yes, they do. But for the majority, if Darius is putting in money in the bank, I'm putting money in the bank, everybody on this video is putting money in the bank is sitting on a significant amount of cash, and they need to do something with it, because it can't just sit there. So the bank is literally taking all of our deposits and lending money out. Darius needs a house, Carmen needs a car, Jim needs this, Susie needs this, and they're taking our money and sending it out. So our deposits in the bank, the storage facility, is now an asset. The banks are going, oh, sure, give me your money. We'll take it. Your checkings account, we'll waive all the fees, whatever it is. Just hold your money with us, because they can now take our money, lend it out, and get paid interest. Right? Darius got a house. Now he's paying principal and interest every single month off of my money. Or off of all of our money. And I just wanted to break that down, because I didn't understand that at first.
Right.
So what we want to teach you with the banking process is do the same thing, but do it for yourself. Do it with your own money. Flip your own money the same way the banks would be doing it.
Yeah. A dollar not in motion is a dollar that's losing money.
Yes.
Or losing its
value.
So the banks understand this very basic concept is money has to stay in motion in order for it to continue growing. There's no middle of the road. Money doesn't just sit. Money is either making money or it's losing money.
Yes.
So for our money that's just sitting in the banks, it's losing money for us, but the banks are out leveraging it so that they can make more money.
Mm-hmm.
And when it comes to banking, we're just going to be doing the exact same thing with our money that we have in our whole life insurance.
Yeah. And the other thing I want to make sure that we're on the same page with is when we talk about banks and financial institutions, by no means are we knocking them. No. What they're doing is genius. It is brilliant. If anything, we are just taking from their blueprint and going, okay, if they're going to charge us this, we're going to charge us the same amount of money. If they're going to flip our money this way, we're going to do the exact same thing. So we're basically looking at them with binoculars on and going, what's happening, so that we can make sure that we duplicate those same systems.
Yeah. And one other thing is the fact that we're looking at the banks after right now, as far as our lifetime. These banks have been around for a very long time. So they have kind of mutated into what we see now. They didn't always start like that. So we have to take that in consideration when we're first starting our system, our banking system, because we're not going to get the same results that they're getting right now.
No.
If you just starting your system, you're not going to get the same exact results that we're getting, because we've been doing this for a few years now. So you have to understand that it takes time. It's a marathon. It's not a sprint.
Yes.
And what we're doing is setting ourselves up for that compound interest growth, which happens the most on the back end of things.
Now, if you're with us, go ahead and like this video. And if you are interested in working with us and creating your own banking system for yourself, then click on the link below to become our client and join the Wealth Nation. So going back to the storage facility, we covered the point of your income comes in, it goes into a storage facility, AKA a bank account. What we are saying, in a sense, is take, some of that disposable income, the money that you do not need to feed your family or pay yourself first, and put that money into a whole life insurance policy with maximum cash value. Big difference between just a regular whole life and one that has maximum cash value. So make sure that you get with an agent who understands how to design them that way, and we can help you do that. But the reason why we say that is because if you are putting money in a savings account, that savings account is earning compound interest, meaning interest on top of interest. We have many videos about compound interest, so we'll link them all over so that you can see them. But what we mean, and essentially, is to keep your money moving. When you put your money in a savings account, you need to be earning some sort of interest so that your money can keep up with inflation. Now, these days, that interest is not keeping up with inflation, so we got to find a place to do so.
Right.
And that's a whole life insurance policy.
And just to shed some light on the fact that your money's earning compound interest in your savings account is because you're not touching it.
Yes.
In order for you to earn compound interest, you can't move it. As soon as you move it out of that location, it's no longer earning compound interest because you've disturbed it.
You disturb the growth. Because how many times do we have something come up? We have $10,000 in our savings account. Something comes up, we need $3,000 immediately. Now we have $7,000, and that has disrupted the growth moving forward in that account. Yeah.
Now, one of the reasons why we like whole life insurance is we have our money in this storage facility, and then when we need the funds, we borrow it. We're still earning compound interest. We're still earning interest because the funds that we borrow has not come from our actual policy. It's used as collateral, and it's coming from the insurance company. So that's one perk just by moving your money into a whole life insurance policy that you have where you don't necessarily have at a bank.
Now, that concept can be a little bit complicated. So I want to make sure that we break it down. So let's do a little role play, shall we?
Okay.
We're married too, so no, I'm teasing.
Do not see us in charades.
Okay. All right. So what Darius said was really important, so that of how this process works, how this really takes off. So he said that if you need money in your whole life insurance policy, you can access the funds, and they're still going to earn compound interest, even though you may have gotten the money in your hand. So how does this work? I need a loan for $10,000. Darius is my life insurance policy, right? So I look in my life insurance policy and I see that there is cash available of $10,000 or more in that policy. So all I do is I call the insurance company and say, hey, insurance company, I see there's $10,000 here.
I have it, $10,000 here.
I would like to get a loan for that amount of money. So the insurance company is going to look at the account, say, oh yeah, there's $10,000 there. And what they're going to do is, Darius being the insurance company, he's going to give me his $10,000. Pay me, please. Pay me my money. So now I am sitting on $10,000 that came from the insurance company.
Mm-hmm.
Why? Because they are holding on to my funds as collateral, meaning their guaranteed payback. Because the bank has collateral, right? They have your house as collateral. They have your car as collateral. If you don't pay them, they're going to come collect. The insurance company does the same thing, but with your policy.
With your death benefit.
Yeah, with your death benefit. So if my death benefit is, $500,000, they know that there's $10,000 in there somewhere. So they're holding that money as collateral in order to give me their money instead. And because I'm using the money from the insurance company, that allows my money to continue to earn the compound interest undisturbed. And I just pay them back once it suits me.
Mm-hmm.
Because the banks, at the end of that's another point, the banks, are going to come collect every single month. The insurance company has their collateral, so they're not necessarily tripping or going to be calling you every single month. But we're not saying that doesn't mean you don't pay your loan back. You need to pay your loan back, but you have a little bit more flexibility as far as when you make the payments back.
Now, before we jump into that, one thing I want to say is, yes, you have $10,000 and you have $500,000 in death benefit. God forbid anything happens. What I would receive from Carmen's on Carmen's behalf is $490,000 because that's the portion that was collateralized.
Mm-hmm. Ooh, and that brings up another point, because we get a lot of people that go, oh, well, if I have cash in the policy and I have the death benefit, and if something happens to, my spouse or significant other, why don't I get both?
It's the same thing.
It's one and the same.
Your cash value or the money that you're loaned is basically an advance of your death benefit.
Exactly. It's an advance of your death benefit. A loan in insurance terms is a prepayment of death benefit. So the insurance company is looking at your death benefit. Like we said, there was $500,000 in there. They're like, yeah, we can give you 10.
Now,
so it's a prepayment of death benefit. It's one and the same.
Now, there is no possibility that you can have more cash value than you have death benefits. So that's something you will never have to worry about, because your cash value, as your cash value increases, your death benefit will increase also, because with these the policy, any dollar that goes in is, again, at the end of the day, is life insurance.
Mm-hmm.
So the additional cash value increases your death benefit. Now, what happens is there's different types of policies that are paid up at 100 years, 121 years.
Mm-hmm.
What will happen is when you get to age,
what does paid up mean?
Paid up is when your cash value and your death benefit equals.
Yes.
Now, your cash value and death benefit equals at the end of that contract, which is when you're 100 years old or 121 years old. That's when your death benefit and your cash value equal.
Mm-hmm.
At that point, the insurance company will say you have outlived this policy, and they will write you a check for every amount of income that you have in that. They'll write you a check for your death benefit.
Yeah. So going back a little bit, I know this title is the basics. We're getting into a little bit more advanced stuff. So when we say your policy, the great thing about using your policy as a source of financing, because if you have that loan for $10,000, instead of using your credit card and swiping, we want to use our life insurance policy, because that money is all going to be coming back to us in our banking system.
Right. Or instead of getting a personal loan, instead of you going to the bank and getting a personal loan, you can use your own system that you've created for yourself.
Mm-hmm.
Because the most important thing, or the genius thing that banks have created, is loans.
Mm-hmm.
Debt is where the money is. Mm-hmm. If you think about what banks actually do, it's debt.
Mm-hmm.
Now, if we can own our own debt or control our debt, that puts us in a really, really good position to take advantage of opportunities that require money.
And owning our debt in the sense of using that same money that we keep talking about, that $10,000, to buy something or to finance something, and paying that money back to ourselves. So bringing it all home, and the thing that we keep talking about when you're creating a banking system is, first and foremost, taking inventory of how much money is leaving your household on an annual basis or even a monthly basis. It doesn't even have to be on a year standpoint. And then figuring out, can I rearrange these funds funds in a particular way where I can redirect that money that's leaving me to come back. And that's where we really like this banking concept, is because when we said, oh, we're in debt well into the 6-figure mark, how can we rearrange these finances to have some of that minimum payments coming back to us? And in our last video, we were talking about, how we paid off debt with our bank. And basically we redirected $2,000 a month coming back to us when it was going away from us, just by using our whole life insurance policy.
Yeah, and it's not just about debt.
No,
let's think about this in 3 phases. Let's think about this in savings, paying ourselves first.
Yes.
Let's think about debt, but let's also think about the money that's coming out of our pocket that we never see again.
Yes.
There's a cost to every single thing that we do. If there's money being spent, there's an opportunity for us to get that money back if we just use our own system, because we're paying somebody for something.
Yeah, I'm glad that you said that, because a lot of times we get people that hit us up and say, Carmen and Darius, I don't have any debt. What am I going to use my policy for? And the point of using the policy is to rearrange those funds like we talk about. So one video that we did where we talked about how we paid off our rent using our policy, that's an expense. That's not debt. It's an expense. That is an expense that we leveraged to redirect those funds to come back to us, which significantly allowed us to have, $1,400 a month coming back to us so that we can use it for cash flow purposes.
Right.
So again, what are the expenses that you're paying on a monthly basis if you don't have debt? Every single time you swipe your credit card for a utility bill, for your roof, for your car, or maybe your car's paid off.
Every time you use
your cable bill, Netflix, it doesn't matter.
Yeah, every time you use your debit card, every time you pay for something, period, is an opportunity. And I guarantee that somebody is making money every time you spend money.
So true. So again, going back to, we keep going back to the loan. If I have $10,000, what am I then going to do since I've taken inventory of my expenses? Am I paying off debt, or am I paying off some reoccurring expenses that I can leverage to redirect funds my way? Because we're going to spend this money anyway. So we don't want you to overcomplicate this process, because we only want you to think of your policy as a storage facility. We have a checkings account, we have a whole life insurance policy. And one thing that I really want to stress is we're only talking about banking. That's another thing that people go, oh, well, this is a poor investment. We're not talking about investing.
We're not talking about the stock market. We're not talking about it's better to use this type of investment to do this. This is not an investment. We're just talking about the basics of where you save your money.
Exactly. Because when you get that loan, then take that money and invest it. Create cash flow, do whatever you need. But first and foremost, make sure that you can put your money, create the foundation where you can put your money in an account that's going to earn a guarantee. Because right now there's no guarantees.
No, because think about this. If everyone decided to go to the bank and withdraw their money,
yes,
we will be up the creek. Kind of like what happened in Venezuela. There was a run on the bank.
Yeah.
So why put your money someplace where you can potentially not have access to it? Right?
Yeah, because I don't know if you all know this. I know we've said this before on many videos, but your deposit, your money that you put in the bank, is an unsecured line of credit. Or not a line of credit, it's an unsecured loan. When you put your money in the bank, there's no guarantee that the bank's going to pay you back. Yeah, there's the FDIC, but again, there's no guarantee that the bank is going to give you your money back.
Right, and they can't afford to give you your money back. I mean,
there's a run on the bank.
What good is an IOU if you can't use it to buy anything? Right? What good is it? And that's basically what the FDIC or tells us, is that they will insure your money up to $250,000, which is great. But how can you insure money that could potentially not be there? The only thing they can do is give you a IOU.
Yep, you can't cash out IOUs.
Now, the difference with the bank is, not the bank, with the life insurance company, is they are governed by states.
Yes.
The bank is governed by is federal. So states have to follow a different level of guidelines. And what that means is every dollar is there. $1 protects $1. So whatever you see inside your death benefit, that is money that's available in the event that you do pass at that very moment.
Yes. Yeah. life insurance companies, when we think of the hierarchy of banks and financial institutions, life insurance companies are right there at the top of the echelon because, like Gary said, they have to guarantee these funds. People die every single day and they can't give you IOUs.
Yeah.
There are no IOUs in that case. And people are submitting death claims, every single hour of every day, unfortunately. So the insurance companies have to do their due diligence to make sure their finances are in order to make the payouts.
And the FDIC is insurance.
How about them apples?
So why don't we cut out the middleman? Because that's all a bank is a middleman, and it goes straight to the source or the big dog.
Yeah, I like that play. That's a good point.
Yeah.
So I hope that everything that we're saying here we're making sense, because we're programmed to think about money in a certain way. We're programmed to think about the banks in a certain way. Oh, they're helping us, that they're providing opportunities for us. And yes, they are. But do we really understand at what cost those opportunities are giving us? When we think about our financial, our education, there's student loans, but now you see, that the youth, people are graduating with debt. That's not really significant when you think about the fact that now people are struggling to find jobs. Unemployment is so significantly high, and half of the American population has student loan debt. Now, what are they going to do with those funds?
And let's put that into perspective. People are graduating from school with debt.
Yes.
So that means the banks are already creating opportunities for themselves before you even start start the race. So what that's telling me is that there's significant opportunities for everyone, all of us collectively, to take advantage of the system that has been created, because we see it, we live it, we do it every single day of our lives. You personally may not have debt, but you're still playing the banking game.
Yeah.
So the only thing we're saying is use a whole life insurance policy to be more efficient with playing that game. And then using that system to invest, using that system to create the returns that you want. Use that investment to use that whole life insurance policy to invest in Bitcoin, if that's what your fancy is.
Yeah, or the stock market, what have you. So going back to the basics of what we were talking about. One, we talked about the storage facility, just rearranging the storage facility. Start with the disposable income that you have and use that to start a policy. It doesn't make sense for you to take your whole income and dump it into a policy, because you're not going to get dollar for dollar return immediately. It's going to take some time to build this.
That's why it's so important for you to understand that this is a marathon.
Yes.
Now, if you don't necessarily have the income, it's something that you may have to wait on, because you're not going to get dollar for dollar back the very first year.
Yeah, exactly. So understanding the storage facility, when the timing makes sense for you to start a policy. Do you have consistent money that you are paying yourself every single month? If so, then let's start a policy and let that be your personal line of credit, so to speak. So anytime you need some sort of financing, or anytime you need to pay for something, borrow it from your policy and create some sort of payment plan where you can pay yourself back. That is something that people struggle to wrap their heads around. Well, how much am I going to pay myself back? When am I going to pay myself back? The beauty about this is it's all up to you. Like we said, the insurance company isn't going to call you every month and give you threats. That they're just going to send you a statement on your anniversary every year and say, this is what you owe us. What do you want to pay? So for us, it's all about making sure if we get that loan, we have to create a payment repayment schedule so that we can make sure we're diligent with these funds. Because if we have to pay the bank back, we got to pay the life insurance company back.
Yeah, absolutely.
So rearranging, the storage facility, using the life insurance policy as a personal line of credit right now while you're living, so that you can take advantage of the funds. Why not? Yeah,
and taking advantage of the funds is super important to the legacy that we want to leave to our family. Or even before we get to the legacy, we're talking about our retirement.
Yeah.
Because let's take your 401k, for example. There's only a certain amount of money that you can put into your 401k every single year.
Yes.
Now, if your lifestyle is significantly higher than what you're able to put into your 401k, then you have to figure out some other way of generating additional income, because the 401k by itself may not do it.
You're right.
So we have to start thinking of this thing for the long term.
You mentioned something with retirement that I think is a big play. The money that grows in your whole life insurance policy grows at the tax deferred rate.
Mhm.
Whereas when you're using a 401k, you're going to be hit with taxes when it's time for you to retire.
Right.
So think about some of those things, because taxes is a huge eroder of wealth.
Yeah. And if we think about taxes have been in the news lately for some reasons. Don't know.
We're not going to touch that.
We're not going to touch that one. But when you think about it, we have a second wave of stimulus coming our way.
Yeah.
And when we think about the fact that everyone's going to get a check cut to them, where do you think that money or repaying that money is going to come from? It's going to come from possibly increasing taxes.
Yes.
So we know what taxes are right now. We don't know what taxes are going to be in the future.
Mm-mm.
That's why we want to utilize our money that we've already paid taxes on to start this, because I would 10 times out of 10 rather pay taxes now on the seed, on a small amount of money
today,
than the amount of money that I'm going to need when I retire.
10 years from now, 50 years from now, who knows what that number is going to be.
Right.
Yeah. I was going to say something, but I just lost my train of thought.
Now, when it comes to lending money, what's important when it comes to lending is the fact that we have control over that.
Mm-hmm.
And
yeah, we do.
What I really like about what I learned after getting involved with creating our own banking system is the fact that we can redistribute money even before the money that we've contract that we create is paid back, which gives us the opportunity to stack interest rates on top of each other.
Yeah.
Because when I take a look at the bank, let's say I had 3 credit cards, I had a car loan, I had a mortgage. When you think about that, that's all coming from the same facility, and we're paying interest on separate transactions, but it's going to the same place.
Yeah.
What does that do for us when we're able to control it ourselves and have separate contracts, but all that interest coming back to ourselves?
Yeah.
Because that makes you think about math differently. Now, for me, statistics with engineering was one thing. Algebra is one thing. Physics is one type of math. And finance is another type of math.
Totally.
Because we think that $1 equals $1. That's for us. But to the bank, $1 equals $10.
Yes.
And we can create that same thing by the way we leverage the money that we have access to.
Now, to that point with the banks, we're getting a little advanced here. I feel like we're getting off the basics, but when Darius says $1 is $10 to the banks, it's because of something called fractional banking, which is what we talk about as well. So anytime you deposit money into the banks only need to have a fraction of your deposits on hand, and they can create this invisible money, so to speak, to lend money to you. So the train of thought that I was the point that I wanted to make before I forgot was, love him or hate him, that he's in the news constantly, but our president, I know I'm going to get a ton of stuff in the comments. Just get the concept of what I'm talking about. When we think about billionaires or people in power, they have really they have an amazing knowledge of how money works. And the point that I'm trying to say here is we get so uncomfortable when we're thinking about different ways to use our money. And it's because we're programmed to think a certain way. Whereas successful individuals, high net worth individuals understand the loopholes and how the money is and how the game is supposed to be played. So they are able to avoid taxes in certain ways, or not avoid taxes. They're
tax savings, implement tax saving opportunities for themselves.
Exactly. So they're not uncomfortable with creative financing. Whereas when it comes to consumers, we are uncomfortable, or we think that, oh, it's too good to be true, or this is a scam, or whatever it is. When whole life insurance policies have been around for over 100 years. And some of us just know how to use the policies more efficient than others. So if this is a concept that maybe you weren't preview to, think about what other things in life you are not being preview to, because we're not given the cheat code.
Yeah. And understand, by every means, whole life insurance is just the bare basics.
Yeah.
It's just the bare basics. Once you open your mind to understanding different concepts, then the floodgates starts to open on the different things and creativity that you can implement inside your system. Because what's keeping us is our ability to create. We have more ability to create income than we give ourselves credit for. We think that a lot of us think that by us going and trading time for money, then that puts us in a better financial position.
Yeah.
If we get a second job, we can get more income.
Yeah.
But what we have to understand is how to best utilize the funds that we currently have most efficiently.
Be as efficient as we can. And that doesn't necessarily mean sweat equity. Maybe it's passive income or finding ways to create residual income without us having to actually go work for it.
Right.
So let's jump into some of the comments. We're only going to answer a few just for time's sake, but we want to make sure that we show everybody love. Thank you all for being here. Go ahead and give us a like while you're here, and let's see what we can dive into. So we have, I'm pretty sure banks didn't like me as soon as I got my check. My check was coming out the next day and all my bills. Well, yes and no. I mean, that they still, like we said, fractional banking. Anytime you deposit $1 into the bank, that explodes into 10. So they still love you. Leveraging your own, great idea. Thank you guys so much. Let's see, what else can we talk about?
How long you should wait to be able to pull money out if you need to? All right, that's a good question, because when the money becomes available as soon as the deposit's there.
Yes.
And if you think about it the frequency in which you pay, if you pay a premium on an annual basis, then the money is available for you immediately. If you pay on a monthly basis, the only thing that's available is what you paid in that policy thus far. So 1/12. If you do biannually, then half of it's available. If you do it quarterly, then 1/4 or 2/4, or I'm sorry, 1/2 of is there after 2 payments. So it depends on the frequency in which you pay your premium.
So think of it this way: if we're thinking on an annual basis, if you pay annually, all of the cash value is going to be available to you immediately. However, if you don't pay annually, the insurance company is only going to give you bits and pieces of the cash value until you pay it in total.
Yeah. Now, when we think about the insurance company and this whole banking system, the insurance company, they're not anybody that you want to play with or that you can play with, so to speak, because banks actually use insurance companies to
source money,
to source their money. So the policy itself is one thing. It's a small piece to this whole thing. What you're doing with those funds is the most important thing.
Yes.
Because your policy is going to do its thing regardless. Matter of fact, the growth in your policy is insignificant in comparison to what you do with those funds.
Yeah. So to bring some context to that is you want to make sure that in some way, if you are getting a loan from your policy, you need to be making money from it. And you need to be really disciplined with making sure that you are paying that money back plus interest, because if not, you're just stealing from yourself and you're putting yourself even further in the hole because you're not being responsible with this insurance policy.
Yeah.
So always make sure that you are making money when you are getting this loan.
Yeah, and that's why we really focus on the fact that you need to have good habits before starting this. You need to understand your money management system before even starting. Understand your cash flow, because what's going to happen is the bad habits are going to get worse.
Yes.
Good habits get better.
Yes. And don't bring that into your banking system. Make sure you have your good habits in line and then start a policy. Okay. So next one is how children's policies. How old should your child be? 15 days old. So as early as 15 days old, you can insure your children. And how long should you wait to be able to pull the money out? We just talked about that. Get the money as soon as you need it. There's no sort of wait time that you need to wait for.
Yeah, this is a good one. How much insurance should I get if I don't have any? Well, the amount of insurance that you can get is based on your income. So let's say, for example, you have a family and you make $100,000 annually. How much money is your family going to be out of if something was to happen to you? So we could say $100,000 income, your family would be out of maybe $3 million over your lifetime. So that's what the insurance company is going to look at when it comes to your death benefit. So you may not be able to get a $3 million policy. You may have to work your way up to it depending on your cash flow. but the maximum amount of death benefit you could qualify for is about $3 million, I would say.
Yeah, but when we think about life insurance, now we're thinking about it on a different end. So you're asking how much insurance that you can get. That's when you're leading with the death benefit. For us, we lead with the cash value. So when we think about how much insurance we can get, it all has to do with our cash flow. How much money can I put into a policy? So that's why we were saying determine what your disposable income is and use that money to start a policy with. Now, keep in mind, your age is going to be a factor, your gender health and your health is going to be a factor. So there may be some plays in which we have to figure out how we can make this affordable. So those are the things that we say that you should do when you're thinking about starting a policy for banking. We're thinking about cash flow, not necessarily the death benefit.
Yeah, another good question here is, do I need good credit to open an infinite banking account?
Great question.
No, you don't.
You don't. Yeah, no, you don't need any credit.
It doesn't. It's not based on the credit. Your credit is basically a report card to borrow money from
the bank.
The bank.
Yeah.
You don't need that when you're looking at a life insurance policy, because it's basically you're getting a policy on the likelihood that you're going to pass away.
Yeah. Now do keep in mind, we do have to preface that the bank isn't looking at your credit score, or the life insurance company isn't looking at your credit score. So you don't necessarily need good credit, but if you have dings on your credit, if you
file for bankruptcy,
if there's some legitimate financial things that come up in your record, the insurance company is going to question it because they need to make sure that you can afford your policy. So just keep that in mind.
Yeah.
There was one point that someone made, said a lady shared her story and stated it took her 3 months for the bank to give her money in order for her to close her account. Really great point. That's exactly what we're talking about, is that the banks don't have your money on hand. So it's going to take some time for you to cash out your account, depending on how much money you have, because the banks are moving money. Mm-hmm. So let's say this. I know a policy isn't an investment, but curious if the interest has ever gone up significantly. Talking about the interest in the
on the
loan. Yeah. So it's been decades since the interest has changed for the loans that you get from a life insurance policy. And again, it really has to do with the stability of the insurance company. When they can guarantee, cash, and when they have actual cash on hand, you're not going to see such fluctuations in the interest like you do with the banks.
Yeah, I can tell you what has changed is actuarial tables where people are living longer. So the cash value that, let's say, was in the 80s isn't the same cash value that we have available currently, because since then people have started to significantly live longer. Therefore, the insurance company needs to cover their bases and make sure that there's enough death benefit there and the numbers work out correctly. So yeah, that's one thing that's changed.
That's a good point.
And will continue to change.
Another question is, how do we find a policy? Great question. First things first, you need to get with an agent that can do these type of policies for you. If you're looking for an agent, we can help you out if you'd like. And click on the link below in the description if you want to be a part of the Wealth Nation. But I would say just do your research.
Yeah.
Google, infinite banking. Do your research. Understand that you should be working with a mutual whole life insurance company. Any will work. A lot of times people try to be competitive. My company is better than yours. They all work the same. They are all a vehicle that is going to allow you to accomplish your financial goals. Mm-hmm. What the game changer is going to be is the agent that you partner with to make sure that they understand what they're doing, because this isn't mainstream knowledge, I would say.
It should be.
Yeah, it should be, but it's not, unfortunately. Once we have zero on our student loans, is it a good idea to borrow from yourself to pay off the student loan and in full and pay the insurance policy back? Yeah.
If you have 0%.
Oh, 0%. I'm sorry. 0%.
If you have 0% interest, if this is the first, don't focus on 0% interest when you first get your loan from your policy, because what you need to do is find ways to make sure that's you get an ROI or return on your money that you use. Yeah.
So with that point, Nelson Nash, who really brought this concept to life, you should look up Become Your Own Banker, the book that he created, which really sheds light on this process, the infinite banking process, is all he talks about is you need to redirect the interest that's leaving you. So if you have 0% interest on credit cards, on student loans, whatever it is, let's find maybe another opportunity for you to pay off something. Do you have something that has a little bit more interest because you want to redirect that interest to come back to you? That's what I would say is the priority.
Yeah.
Because when you get a loan, you need to make sure that you have a payback, because there is a fee that's going to be associated with getting a loan with the insurance company. Let's see, what else?
Is there advantageous to have more than one insurance policy? Well, it is.
Simple question. How many banks do you want?
As many as I can have.
Exactly. Yes. Yes is the answer. Is it advantageous? Yes.
So here's the thing when it comes to banking and having more than one policy. If let's take us for example, when we first got our policy, our cash flow was one way. But as we started redirecting funds to ourselves, our cash flow increased, our income increased. So we had more money available to get more policies that we didn't have when we first started. So I guess you would naturally get more policies because your income and your cash flow is going to significantly increase because of how your understanding of money changes as you go through this process. Yeah.
So Darius and I, we have 5 policies, working on our 6th, and our mentor who introduced us to this whole process has over 100. So think about that for apples.
Yeah.
The next thing is, if the policy is attached to a trust, are you able to borrow from the policy based on the value of the trust? No. Good question. When you borrow from the policy, it's only based off of what you have in the policy. So really good question. What else?
Should I think about my bank as my emergency fund? That's a good question. Yes. You can think about it as your emergency fund because of the.
Can we say opportunity fund?
Yeah.
Let's say opportunity fund. We know what you mean by emergency fund, but let's think positive instead of negatively. If opportunities come up, absolutely, you have the opportunity to pay off whatever comes your way, regardless of what it is.
Yeah, absolutely. Because if that money is designated for your opportunity fund, if it's not being utilized in your investments, it's still earning more interest than it would if it's just sitting in your savings account.
Yeah. The next question that we have is, what company should I go with? We talked about that earlier. Any mutual whole life insurance company. Just make sure your agent knows how to design the policies. What is your suggestion about loan against a home if you don't have a policy? Right? Do you understand that question? What is your suggestion about loan against home if I don't have a policy?
So basically using their house,
your home equity line of credit?
Home equity line of credit in the place of life insurance.
Why not? What are your thoughts?
I don't have any thoughts about it.
For us, it's all about creative financing. So if you have money somewhere, then why not? Well, okay. I take that back. Using your home equity line of credit as a bank, if that's what you're saying, I would say no, because of the fact that it's not going to produce any guarantees, and then there's no death benefit. So if something were to happen, so I would leverage the line of credit to start a banking system.
Yeah, when I think of a home equity line of credit, I'm thinking of using the equity that I have in a rental property to buy another rental property. If it's my main house, then I'm not trying to use a home equity line of credit on the house that I currently live in, unless I'm going to be using it for some type of investment that's to make more money.
Yeah. So put that money in an environment where you're going to, again, get those guarantees where your money is going to grow. Because if you just use your HELOC as its own bank, you're just constantly, paying Peter to pay Paul, coming back, but there's really no gain, if that makes sense. But I mean, you could be getting more credit from the bank, yes, but the point is for you to grow your own system.
Yeah.
Let's see, just a few more questions and then we'll sign off. Is there an interest rate on the policy? Is the interest daily or annually? It's on an annual basis. Is it good for me to invest in whole life if I was planning to save money in order to get a loan?
Don't invest in whole life.
Yeah.
It's not an investment.
Yeah, we talked about that earlier. This is just banking. So we're creating a storage facility. So the question I'm going to ask for you, is it good for you to change your storage facility where you put your money and then use that money to invest?
Yeah.
Let's see what else. You're welcome. So talking about, do I still need to do velocity banking to pay off debt? Good question. I think it just depends on what your goals are. You know, are you trying to create a banking system for yourself where you're going to redirect all of those funds back to you? Or do you want to continue to leverage someone else's banking system to continue to play their game and get more credit?
Yeah.
If we simplify it, and I know there's more that goes into both, but just think about, are you building your own bank or somebody else's?
Yeah. And just velocity banking is a great tool.
It's an amazing debt weapon.
It's an amazing tool to use. But when I think about what I'm able to pass on to my daughter is I just can't give her my credit cards.
No.
I can't give her my line of credits. I can't give her my good credit score. That's something that she's going to have to build. But what I can give her is keys to a banking system.
I like that point. What's the difference between velocity banking and infinite banking? We have a video about that actually on our channel. So definitely check that out, where we talk to the amazing Mr. Denzel Washington. Denzel Rodriguez. Yes. One day we will be speaking to Denzel Washington.
I like this one. He said, how do I credit check family members and other people so that they can utilize my bank to make more money?
You should have them pull their own credit score. 620. Yeah, no, you can't borrow from me, bro. No, I'm teasing. But I'm joking, but I'm being dead serious, because if your friends and family aren't good stewards of the bank, they're not going to be good stewards with you. No matter how much you wish and you want them to be, you have to look at their history. And if you do lend the money, you better make sure you get collateral.
Oh yeah.
And that you come collect. Don't be nice. The banks aren't going to be nice.
Yeah, so make sure you get collateral on something that you can actually use or something that you want. So like for us, when we were doing real estate investing, the collateral that we had when we lent money was the house. And we knew exactly what we wanted to do with that house if that money wasn't paid back.
Yes.
And a lot of times, in some cases, what banks do is they would rather have the collateral than they would the actual money. Because if we think about real estate, what we're going to collateralize is something that has a higher value than what we lent the money on in the first place, because that creates a sense of urgency in paying you your money back.
Oh yeah, that's a really great point. So just make sure you cover your bases. Again, we said the banks have the foundation, do what the banks would do. Can you pay us to do the paperwork for your life insurance policy? You can pay us if you want to, but we're not going to charge you to do that.
Yeah, because the fees are already baked into the policy. That's why.
Sorry, go ahead.
No, the fees are, just think about when you're using a financial advisor, when you're using a real estate agent to buy a house, their fees are already baked into the policy itself, or the service that you're getting. Yeah. So there's no additional fees for your agent to do the information for you or to do the paperwork for you.
Yeah, you don't need to come out of pocket. And then the next question that we have is, do we teach others? Well, so our whole YouTube channel is about teaching you how this infinite banking process works. So I'd say just, start watching a lot of our videos so that you can understand the foundation, but we don't have a course right now where we are teaching licensed agents how to do this for themselves.
Yeah, and I understand you have a insurance license. When you get an insurance license, you're not going to learn any of these concepts that we're talking about. Matter of fact, in our book, cash value was mentioned 3 times in the entire book when we got our insurance license. So these concepts you have to understand and learn.
How this works. And if you guys are still with us, give us a thumbs up on this video. Thank you so much for hanging out with us. A lot of people are asking, how do you contact us? How do you work with us? In every single video that we have on YouTube, there is a link that says become our client. Click on that link. We're going to take you through a masterclass so you can really understand the ins and outs of infinite banking and how we use them. And then you will be prompted to apply to become our client. So in the description in any one of our videos, click on that link that says become our client, and you will be routed to our team. So thank you all so much for hanging out with us, for rocking with us, for all of your amazing questions. We appreciate the love. We appreciate the engagement. Again, give us a thumbs up, and we will see you on Thursday for our next video. And remember to own your own lifestyle,
or someone else will.
Take care, guys.